The following case study for business owners Mark and Ellen Resnick, tax attorneys Max McCauley and Herb Fineburg illustrate an estate and gift tax planning strategy for how to remove your business from your taxable estate. This tax planning also works for your stock portfolio. In the following case study, the total federal estate tax savings to the Resnick children is a minimum of $14 million on a business valued at $40 million. If you include future appreciation, the total federal estate tax savings jumps to $33 million on an appreciated estate of $80 million. As explained, additional tax savings are achieved by preserving the trust assets by paying the trust's income taxes from assets not in the trust. In the illustration, Mark and Ellen Resnick hold their business or the sale proceeds in an irrevocable trust, of which they are the lifetime trust beneficiaries. In essence, the Resnicks retain access to the business assets for their entire lifetime, but are not treated as the owners for federal estate tax purposes. This is a win-win for the Resnick children and grandchildren. This planning technique is how families preserve family wealth for many generations to come. Let's see the details of how this planning works.
We put the family business into each of the trusts. Each of them have a 50% interest in the family business worth $40 million. The next thing we do is we provide that each of their 50% interest will be broken down into voting and non-voting interests. We use the non-voting interests because they are helpful in getting material discounts when making gifting. The main strategy in any gifting plan is to use a discount. As I said earlier, the IRS is anxious to fight the concept of a discount when both the husband and wife own 100%. Why is there a discount for non-voting interests? And the courts have regularly held there is. We're going to value the non-voting interest even though the family before and after the gift controls the company. We set up for Mark and Ellen, each of them have a spousal lifetime access trust. And this is a trust where Mark would give his interest to this, what we call a slat, and the beneficiary of the slat would be Ellen for her whole life. So Mark, by transferring those assets into this slat, has removed them from his taxable estate, his and Ellen's taxable estate. Ellen's going to do the same thing. She's going to transfer it. You'll see on the right-hand side a spousal lifetime access trust, and Mark will be the beneficiary of that trust. So even though they've given their assets away and they removed them from their estate, conveniently, they get to use the assets for the rest of their life.
A lot of our clients say, well, I don't want to lose control. Well, this is important. So Family Ventures is set up as a manager-managed LLC, and that could be Mark and Ellen as the managers. It could be Mark as the manager. It could be Ellen as the manager. Whoever was in control of the business before can remain in control of the business. But the valuation discount of the business of $4 million saved you nearly $2 million in taxes top line. The minority discount and the lack of marketability discount saved you another $6 million in taxes. The disappearing exemption, another 5.8. Total tax savings so far at $14 million just through proper structuring.
And earlier on, I had said that if Ellen and Mark sold their business for $40 million and they lived another 20 years, it is conceivable that that $40 million could grow to $80 million. What that does is it saves an additional $19,800,000 in taxes. And when you add that to the tax savings before appreciation, you can see that the family would have a tremendous amount of tax savings. So what we're doing is, and these numbers, we often talk about the unified credit as the value of the asset, $11,700,000. And I'm using the same technique here to show you what is growing outside of the estate. So what has happened is The table on the left is showing the taxable estate after the sale, including the appreciation of the assets, with no planning. And in that situation, the couple have, what we're assuming for the moment, that the couple has their one exemption of about $6 million each, or a total of about $12 million. And here we're using the exact number of $11,700,000. So they did nothing. Their tax bill, when they passed away, for the children to pay, using the 49.5%, 45% for federal, 4.5% for Pennsylvania, they end up with a tax bill of $40 million, $40 million plus. If you did the planning that we did a few slides earlier, simply by transferring the business to the slats, at 99% interest of the slats, they would have used up their exemption, so they would have no exemption. They would have a taxable estate of the assets left in their estate of about $13,665,000, and they'd have a tax bill of $6,764,000. So simply by transferring their interest to a slat, they have saved $33,808,000 of tax savings. It is inexcusable to do nothing.
In addition to the estate tax reduction due to business strategies, we can further reduce the estate tax due through investment strategies. In other words, through the sale of the investment portfolio.